So, what professionals mean by risk and why retail gets it wrong. In retail trading, risk is usually defined as how much money you could lose on a trade. That definition sounds reasonable, but it's incomplete. And more importantly, it leads to bad decisions. This channel focuses on how markets work through professional trading and macro frameworks. This is not financial advice, and I'm not licensed advisor. This is analysis and not instruction. So, what's the retail definition of risk? For most retail traders, risk means loss. How many dollars could I lose? Where's my stop? What's the risk to reward ratio? Those questions aren't wrong, but they're too narrow. They reduce risk to a single outcome, when in reality, markets operate across a range of outcomes. Professionals don't ignore loss. They just don't start there. For professionals, risk is uncertainty. Not whether you lose money, but how many different outcomes are possible and how exposed you are to each one. Risk is the distribution of outcomes, not the worst case number. That includes volatility, correlation, liquidity, and how positions behave under stress. Loss is consequence of risk, and it's not the definition of it. So why stops don't define risk? Retail traders often treat stops as risk control, but stops don't remove risk. They just define where you exit under normal conditions. In fast markets, stops slip. In liquid markets, they fail. In stressed environments, they disappear. Professionals assume markets will behave badly at the worst possible time. That assumption shapes everything else. So, another key difference is where risk control actually happens. Retail traders focus on finding better entries. Professionals focus on sizing. A mediocre idea, sized correctly, can survive uncertainty. A great idea, sized poorly, can destroy an account. Risk is managed at the portfolio level, not the trade level. This is a fundamental mindset shift. So, this is where options enter the picture. Options exist because professionals want to shape risk, not just take it. They allow exposure to uncertainty without unlimited downside. They allow asymmetry in environments where prediction is unreliable. Options aren't about being right. They're about surviving being wrong. So what retail gets backward? Retail traders often treat risk as something to minimize on each trade. Professionals treat risk as something to distribute intelligently over time. That's why professional portfolios are built around exposure, not opinions. Certainty is fragile. Risk awareness is robust. So, in conclusion, If you define risk only as loss, you'll always be reacting. And if you define risk as uncertainty, you can start designing around it. That difference explains more about professional trading than most strategies ever will.